All right. Today is Monday, December 13th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. But before we start, I forgot to say something last night. When we talked about inflation and the tornadoes, I forgot to say my heartfelt condolences, the victims of the tragedy of the tornadoes over Kentucky and other territories. My hopes for a speedy recovery. And with that out of the way, let's get down to business. And here it is, in focus tonight. We're going to talk about Apple's iMob propaganda machine. They've been pumping Apple in the last couple of weeks, dubbing it as safety, the safety stock. Pumping. Meanwhile, you and I know, from watching this program of course, that the pump in Apple stock is due to the options market manipulation only. And that's all there is. It's a pump and dump done via the options market for whatever purpose. But let's talk about Apple and the iMob in general, because here it is. We have a company that ceased to innovate since Steve Jobs died. Actual, real, tangible innovation. That doesn't exist anymore in Apple. So new CEO Tim Apple figured out a new trick by turning the company into a mafia-like operation, a racketeering operation using Apple's monopoly powers. Instead of innovating, why not parasite on other innovators? By the racket, the scam they call the App Store. They're bullying app developers into kicking 30% of the revenues to Apple. For what? And if you are an app developer and you defy the iMob, guess what? They're going to threaten you. You don't pay us the 30%, the cut. We're going to crack your kneecaps. We ban you from the store unless you pay us the rent. The rent.
We came for the rent. The rent. The rent.
And on top of that, the iMob has a machine, a propaganda machine of so-called analysts whose sole job is to prop up Apple stock higher and to put a lipstick on a pig by painting the company as an innovator. Meanwhile, the only thing Apple has innovated since Tim Apple took the helm of power is share buybacks. That's all there is. But these propagandists have no shame at all. They'll do what they're told when they're told. And one has to question why all of a sudden all of them came out in the last couple of weeks pumping Apple stock higher. Why? You can accuse me of being a conspiracy theorist and the tinfoil hat, yada yada yada. But you gotta be a baby, a naive baby, if you don't smell it already. This is an organized effort to pump Apple stock higher. They all came out of the woodwork, pumping like crazy. And that came hand in hand with the gamma squeeze in the options market, aka the manipulation. And where's the SEC, you might ask? The SEC is in a coma. Nothing new here. But you really think that this is not an organized effort, a coordinated effort? Think again. And I know it's blasphemy to criticize Apple because everybody likes Apple, everybody owns Apple in their portfolios, and nobody's supposed to criticize Apple whatsoever. Well, guess what? You're in the wrong channel, bitch, because we criticize the uncriticizable here. My job is to spell the truth on this facade, on this garbage narrative by the media, the financial media, which serves no purpose at all but being propagandists and pumpers for hedge funds and companies. And in doing so, they mislead mom and pop investors, retail investors all the time. When you think about it, last week, Katie Huberty, the top propagandist for Apple for Morgan Stanley, came out upgrading Apple target to 200. And then came KeyBank, also upgrading Apple. And today, JP Morgan, also pumping Apple higher. And we had many so-called analysts, professional propagandists, paid propagandists, pumping Apple higher. Chiefly Wade Bush, Dane Ivis, also known as the Thupathakal. And Mr. Thupathakal has a thesis on why he's pumping Apple. Take a listen.
That's exactly. I think demand outstripping supply by about 15%. In terms of iPhone 13s. Yeah, and I think that's really the key. There's a lot of gyrations in the supply chains we've seen, but what this ultimately means is that the street's underestimating the growth in terms of this iPhone 13, sort of the second step of the super cycle playing out. China remains strong, and I think on a sum of the parts, this is not just $3 trillion. We could see this ultimately $3.5 trillion, especially as this all plays out along with services.
And of course, this is garbage. He's been pumping the Thupathakal for 4 years now. How long will the super cycle last? And he says the Apple iPhone 13 will be a hit. Well, guess what? The facts say it's not. Apple, the company itself, says our demand is down. But that doesn't matter for Ivis and the other propagandists. They do what they're told when they're told, and that's all there is. And then we have Roger McNamee, who's, by the look at it, knows the good stuff. He smokes the good stuff. You can bet on that. With that Ozzy Osbourne look, you bet he knows how to smoke the good stuff. The problem is when you smoke the good stuff during daytime while you're doing interviews, then you start to stumble all over the place. So what is McNamee's thesis in pumping Apple? Here it is. Take a listen.
I think Apple is as well positioned as any tech company in America. You know, the thing that they have done better than anyone else is control their supply chain and hardware. And, you know, the new chips, the ones that they designed, are groundbreaking. You know, from Apple's perspective, the challenges they face are the same that the other big tech companies face, which is to say regulation, potential antitrust action. But in Apple's case, the potential impact of those things is much smaller. So I think Apple's situation is just really terrific right now, as long as you like the market.
Yeah, how do you balance that? And I ask that because I know Apple just did win this delay in this monopoly case where its App Store is concerned, but certainly still getting a lot of that scrutiny, not just here in the U.S., but abroad. But it does also focus very heavily on privacy. We've seen the impact of that on other companies, for example, Meta and advertising companies and the like as well. So how do you balance those two with each other?
So Apple's been put in this really awkward situation where effectively it is the privacy regulator in the United States. They don't like being in that position. And yet for their business, they have to be there because privacy is their brand.
And if the thesis in pumping Apple, according to McNamee, is privacy, Apple is the king of privacy, boy, you've been smoking a lot of good stuff. And to his credit, of course, he talked about it in that interview later on. But in the latest privacy update for Apple, they're allowing companies like Facebook to track you. On paper, the new privacy rules are strict, and they're here to protect you. Of course not, because they're allowing app developers and other large companies, the likes of Facebook, to circumvent the system and track the users, Apple users. So what privacy are you talking about? Apple also admitted that their phones were compromised by the Israeli spyware. So again, what privacy if the phone can be easily compromised and the entire software can be easily compromised too? But according to the propagandists, of course, we should add another trillion to Apple's valuations due to privacy. Wow. Here's privacy for you. Italy just fined Apple and other companies over privacy. Even Polish regulators are now investigating Apple's privacy policy because guess what? There is no privacy in Apple's privacy policy. Forbes says Apple's best iPhone privacy feature has a surprising problem. And here it is, the details. The headlines have painted Apple as a hero with its App Tracking Transparency ATT iPhone feature introduced in the iOS 14.5, beating Facebook by halting its ability to track people across other apps and websites. And this is, of course, the creep Mark Zuckerberg who likes to spy on people. After all, this is how he invented the company, right? Instead of changing the name to Meta, how about changing the name to the Peeping Tom? It's more appropriate that way. But continuing with the article, here it is. Of course, the background is Apple is cracking down on Facebook and how they track users, yada yada yada. But here's the reality. But the tone been changing of late as people realize the surprising problem with Apple's best iPhone privacy feature. It doesn't stop all tracking, and it is open to interpretation. That is the subject of a new report in respected UK newspaper, the Financial Times, which says Apple is letting the likes of Snapchat and Facebook get away with some tracking of iPhone users. I bet Facebook is giving kickbacks to Apple. That's the shakedown revenue. What does Apple's ATT feature do? When an iPhone user says no to tracking, Apple specifically takes away the identifier for advertisers, also known as IDFA, from the developer. Apple is able to perform this task on technical level by revoking access to the unique number that identifies your specific iPhone and replacing it with a string of zeros. Here's the problem. But app makers are still acquiring user-level data that is anonymized and aggregated with other devices, Mac rumors point out. This doesn't tie the data to a specific iPhone. The FT calls it an unacknowledged shift that lets companies follow a much looser interpretation of its controversial privacy policy. And here's the response from the iMob. Apple's website says it is not considered tracking, quote-unquote, when the data is linked solely on the end user's device and is not sent off the device in a way that can identify the end user or the device. Who gives a shit? At the end of the day, they're going to be able to track you either way. So whether they have the identifier or not, You're being tracked. And by being tracked, think about it. Facebook doesn't need the identifier to know who you are. Once they're able to track you in the phone, they know exactly who you are. So this is all garbage. Apple is putting a facade out there that they have a privacy mode. In reality, they're allowing other developers, specifically huge developers, to track you. I'm pretty sure they're getting kickbacks from that operation alone. Another racketeering operation. But perhaps the most hilarious pumper is Gene Munster from Loop Ventures. He has no shame at all. What is his thesis in pumping Apple? Here it is. Take a look.
David, it's based on a simple logic and framework I've used all along, and I've always wanted to get it right on the way up and be the first to call it when it's ready to go down. But that simple framework is based on a truth that investing in period, and in particular investing in Apple, is related to predicting what's next. And in Apple's case, they have had these what's next every 5 years. They've reinvented themselves.
Reinvented themselves by new colors, a new shade of orange. Wow.
Whether it be the iPhone, services, and here we are at the cusp of yet another reinvention, potentially two reinventions. And that's why I remain optimistic. I believe that the company's best days are yet to come. And I just want to quickly frame in the optimism. Is that we have the core business is predictable. It's having a headwind with the supply issues that we can talk about. But really fast forwarding beyond those supply constraints is that the two big opportunities for the company are centered in the metaverse and autonomy. The metaverse is going to be real for Apple. They will have hardware. We think that they will preview in 2022 mixed reality goggles. It's going to take years for these to become mainstream. But again, investing is about what is coming next, and that is something that can be material to Apple's business. And then, of course, there's auto and autonomy.
So he is pumping Apple higher due to the metaverse and autonomy. And look at that screen, by the way. He says that a 35 multiple for Apple, the largest stock in the world, is reasonable. But watch how quickly he's going to take it back in a hilarious fashion, of course.
And I'm cautious about endorsing this theme too much, given my mistakes around the television in the past, and seeing what Apple works on doesn't necessarily see the light of day. But if I can just quickly frame in the auto opportunity, is that they have 20% market share on mobile today. If they get 10% in auto, that's a $540 billion business. They're going to do $380 billion next year. I mean, this could be massive for them. Again, caution, we're years away, but the point of investing is to be in front of these curves. And when you put it together, to have that optionality and trading at under 30 times, I think is a bargain.
So far, Gene Munster has been pumping. Autonomous this, metaverse that, trillion here, trillion there, trillion everywhere. Everybody gets a trillion, you get a trillion, he gets a trillion, she gets a trillion, right? Meanwhile, he says, I've been wrong before. I've been pumping Apple stock before based on shit that never happened. So take whatever I say with a grain of salt. What a genius. And it gets even better. Take a listen.
But for the real upside to kick in, I need to be right on this, that they need to get into one of these two. I feel with high conviction that they're going to do something around mixed and augmented reality and glasses in the years to come. And I have high conviction, despite my apprehensions about the world of the metaverse, that it is the future. And then, of course, the car. So to answer your question, Morgan, is if I'm wrong on both of those, I still think there's upside to the stock.
The city can't say far. The council can't say anything.
What a load of filth. He's been pumping, metaverse, autonomous cars, glasses, IR, VR, iCondoms, iDildos. And then he says, for the real upside to happen in the stock, I have to be right on all of this. Then a few seconds later he says, and if I'm wrong about all of this, the stock is still gonna go higher. Just buy the f***ing stock already. They paid me to pump, and I'm pumping. And you wonder why this channel, the viewership in this channel is exploding higher. Because people are sick and tired of the filth and the garbage in the media. We have a lot of YouTubers calling out the political media, for example, CNN, Fox, MSNBC. But who's out there calling the business news media out? Who's calling out the filth coming out of CNBC, Bloomberg, Wall Street Journal, and all of these so-called analysts? Who's doing that beside this channel? And therefore people are listening because they're sick and tired of the manipulation and the garbage narrative, the endless pumping with no regard whatsoever to mom and pop investors. They're pumping on behalf of hedge funds and corporations, and that's all there is. And people are sick and tired of this scam, and it has to be called out. And this is one of the few channels available out there calling this shit every single day. And by the way, besides the lack of innovation, which is hurting the United States of America, by the way, because Chinese companies continue to innovate rather than buying shares. Here we have the opposite. The largest company in the world spends billions and billions of dollars, not on innovating new products, but in buying back their shares to pump the stock higher. This is going to kill us in the future in the battle against China. But this is not surprising, of course. Apple is in the pockets of the CCP. I'm not here to give you advice that if you buy Apple, you're funding the CCP and it's an unethical investment, because I invest in these criminal companies too. Not Apple, but banks, pharma, military contractors, yada, yada, yada. So I'm not going to give you advice from a glass house saying you shouldn't buy Apple or invest in these companies. They're all criminals anyways, but this is as close as you can get to a treasonous company. Not so long ago, we got the revelation from Information, a publication that exposed Apple's ties to the CCP. And here's the headline from TheVerge.com. Apple's concessions in China's reportedly include a secret $275 billion deal and one odd change in maps. And that is, of course, to make the islands bigger. Listen to this. A 1,250-word memorandum of understanding between Apple and China's National Development and Reform Commission, another face for the CCP, reportedly runs for 5 years and accounted for $275 billion in spending. That includes a request Apple reportedly received in 2014 or 2015 about a small group of uninhabited islands that China and Japan apparently have a dispute over in terms of who owns them, going by either the Senkaku Islands or the Diaoyu Islands, depending on which side of the argument you're taking. They inspired a request from China to members of the Maps team to make them appear larger, even when viewers are zoomed out on the map. According to the Information, not only did Apple eventually make the change, but even today, for viewers using its map from within China, the islands are still shown at a larger scale than the territories around them. And here's the picture for the island. And rumor has it, if you pay Apple $275 billion, they'll also make your penis bigger. No need for those rhino pills anymore. But here it is. The report also details disputes over everything from iTunes to iCloud to Apple Pay. The figure that looms over everything is a 1,250-word memorandum of understanding that the Information says Tim Cook signed. Once again, Tim Cook signed during a publicized trip to China in 2016. The way it's laid out, Cook went to China because of repeated regulatory action affecting Apple's business, by signing a 5-year agreement with an option to extend it to a 6th year, promising investments, business deals, and training in China worth an estimated $275 billion. The aim was to avoid further disruption. What happens after the contract expires, by the way? Does Apple get the boot from China? Isn't this what investors need to hear? That Apple has a contract with China, and who knows what's going to happen after the contract expires? And we now know why Apple was untouched during the trade war under the Trump administration. Well, if you didn't know, now you know. And before we move out, folks, I talked about the 1970s, and I'm going to make a video about the 1970s inflation. We're going to do that in the next video because it's not as time sensitive as this subject, and the reason is Apple stock reversed from the highs today, aggressively so, by the way. And if Apple goes down, the entire market will go down with it. And with that, ladies and gentlemen, let's move on to the market's coverage, starting with the performance. And here we go. The Dow Industrial Average closed in the red, down by 320.4 points, or a decline of 0.89%. The Nasdaq also down by 217.32 points, or a decline of 1.39%. The S&P 500 also down by 43.5 points, or a decline of 0.91%. And what about the sector's performance today? Leading the pack at number 1 and capturing gold, utilities. Number 2 for the silver, healthcare. Number 3 for the bronze, defensives. The laggards of the day led by energy, cyclicals, and technology. The theme is obvious today. It is defensive. It's led by utilities, healthcare, and defensives. Now, when it comes to utilities and REITs, I'm a little hesitant here because they're going to be sensitive to the bond market and how the 10-year yield performs. If the 10-year yield goes down, utilities and REITs going to go higher. However, if for whatever reason yields go higher, utilities and REITs are not going to perform. And therefore, I'm sticking to healthcare and defensives. These are the true defensives in the market right now. The consumer staples and the big pharma / healthcare companies, health insurance, Abbott Laboratory, and those kind of names. What about the advance to decline ratios for the market today? NYSE 30% advancing versus 67% declining. The Nasdaq 33% advancing versus 64% declining. And by the way, look at the 52 new week lows for the Nasdaq. 216 stocks reaching 52 weeks lows today versus 24 stocks reaching 52 weeks highs. The breadth remains awful for the Nasdaq. Moving on to futures. What's going on here? Crude oil futures are not down by a lot. The WTI is down by about half a percentage point today. So did gasoline, but the bulk of losses came from natural gas, down by a little over 2.5%. Now, you and I know that oil is in a super cycle, right? And therefore, oil prices will continue to go higher and higher and higher, absent of the Fed being really aggressive with interest rates hikes. We have a lot of tailwinds for oil prices to continue to rise higher. Matter of fact, over the weekend, the Saudi oil minister came out and said, warning that a slowdown in fossil fuel investment globally will cause spikes in energy prices. In other words, the Saudi minister said, are you dummies really going to let us win the jackpot that easily? No challenge at all, because we would love higher oil prices. When you look at the Saudi economy, for example, it is booming for the first time since oil prices started to crash. The first time in almost a decade. And we called that in this channel a while ago. And therefore, I am investing in KSA, the ticker KSA, which tracks the Saudi stock market. And it has been performing better than individual oil stocks. Yes, it's under correction right now. Every oil stock, every oil ETF went down after the Pokemon variant, but who's to say that oil prices are not going to recover higher again? We will go over all of these positions before the end of the year when I do my portfolio review. In the meantime, back to futures, here it is. What's going on with softs? The rally in lumber continues to go on. Lumber futures gaining another 4% today alone. Unbelievable. Likewise, we have gains for cocoa futures, coffee, and cotton, while we're having declines for OJ and sugar futures. OJ gotta keep the 120 line, otherwise the reverse head and shoulder formation that we talked about last night, not gonna happen. And what about metals? What's going on here? We have modest gains for silver, copper, and gold. On the other hand, losses, big ones, led by palladium down over 4% today alone, and then platinum down a little over 1% today. I'm watching gold closely here, and I'm starting to like gold. I tweeted that we have a lot of calls out there saying that gold will crash, run for the hills, yada yada yada. I say if the dollar goes down, along with the 10-year after Powell comes out as hawkish on Wednesday, I believe that the bond market will crash the 10-year yield as to send a message to Powell that if you do indeed raise interest rates right now, you're going to push the economy into a recession. It doesn't matter because this is the remedy for now. Your choices are either stagflation or a recession. Powell is going to choose a recession, hoping, of course, for a soft landing. These are all fantasies, of course, but regardless, if the dollar goes down and the 10-year yield also goes down with it, then gold will shine again. What about meats? Modest gains for both feeder and live cattle futures. On the other hand, lean hogs futures going down with a little bit of losses here, nothing major. Lastly, what about grains? We have modest gains for both wheat and canola futures. On the other hand, we have losses led by soybean, soybean meal, oats, corn, soybean oil, and rough rice, all closing in the red today. Moving on to the big casino, the options market. What's going on here? The hottest table by far, per usual, is Apple, with about 2.5 million contracts traded hands today. About 72% of those were calls. And here it is at number 2, Ford, with a little over 800,000 contracts exchanging hands today. About 53% of those were calls. And at number 3, the tragedy of the apes, AMC, with a little over 700,000 contracts traded today. About 50% of those were calls. We're going to talk about AMC, of course, in the charts analysis. In the meantime, we're moving on to the unusual activities that took place in the options market today. Starting with the ticker MQ for Marqeta. The name is down big today. and it is down top to bottom over 50%. Somebody is betting for more pain to come here for this name by buying the $15 puts for the expiration date January 21st with the expectations that the name could go down by more than 12% by then. They paid about $1 a piece to enter this trade, all in all spending about $2 million. And what about the trade for the ticker AMC? The apes are planning a rescue here, buying the 26 calls for the expiration date this Friday, December 17th, with the expectations that AMC could pop higher by more than 13% by then. They paid about $1 a piece to enter this trade, all in all spending about $1.5 million. The number 26 is important. This is not an arbitrary move. This is done by design. They know that 26 is important, and they're going to climb 26 by the end of the week or game over. And what about the trade for the ticker MGM for, you guessed it, MGM? They're buying calls here, the 44 calls for the expiration date January 21st, with the expectations that the name could pop higher by more than 9% by then. They paid about 90 cents a piece to enter this trade, all in all spending about $1 million. What about the trade for the ticker ARKKKKKK? For Tesla witch Kathy Wood? The bears are aggressive. I'm proud of you, of course. They're hitting Mama Kathy left and right with such aggression that I've never seen before. Certainly not recently, because the bears have been pussies as of late, scared of shorting anything. The market just continues to go higher, bro. It's never gonna stop. Meanwhile, we shorted DocuSign, we crushed DocuSign. We shorted Zoom, we crushed Zoom. We shorted Peloton, we crushed Peloton. And that was before Mr. Big, by the way. And here it is, RKKKKKKGOS once again. And the shorts are piling in. Now they're buying the 85 puts for the expiration date, December 23rd, with the expectations that the name could go down by more than 10% by then, and they paid about 85 cents a piece to enter this trade, all in all spending about $800,000. And lastly, what about the trade for the ticker NEU? And this is not the trade that I want to share with you. This is the trade that I want to share with you, and it caught all observers' eyes today. The ticker NEU for New Market. This is a small cap energy company. Somebody bought the 360 puts for the expiration date December 12th, meaning this Friday, and they paid about $32 a piece to enter this trade. All in all, spending about $31 million. A huge trade. Somebody knows something here. They're buying calls, they're buying puts, but something will happen in this company. I don't know what it is, but it is highly suspicious, of course. Moving on to the heat map analysis. What's going on here? As I told you last night, when you remove the oversold bounced garbage, you're going to be left with true safety, actual safety. What does that mean? Consumer defensives, specifically staples, and then you have healthcare, utilities, and REITs. Now, we talked about utilities and REITs and their sensitivity to the yield, specifically the 10-year yield, and therefore I'm not so sure about utilities and REITs. But what I'm sure about is healthcare and consumer staples. This is true safety. Not even the mega cap technology stocks are safety. The only safety is high cash flow and high dividends. And therefore I'm hiding in healthcare and consumer staples for now. Some of the notable movers to the downside happen to be the reopening names, but specifically travel and cruises. Cruises down big today. Perhaps this is a contributor. We have a woman who fell overboard from a Carnival cruise in Mexico, as if cruises needed more pain, but here it is. The notable mover to the upside, bucking the trend, is Meta, aka Facebook. Not sure why, but I read the story of a woman who had the handle Metaverse on Instagram, and you'd think that Facebook is going to buy her out, right? You already own the username, we're going to pay you a certain amount of money to take it off your hands. Not true. What Facebook did instead is suspend her account due to impersonation. And these criminals have no shame at all. With all the money they're making in the stock market, all the revenue, they can't buy her out? Absolutely ridiculous. But who cares, because I'm moving on to the charts analysis, starting with SPY, 30 minutes chart. What's going on here? Again, trading flattish, within range, and not losing 466. I know we had a bad day in the market today, but the chart for the SPY says neutral. Still favors the bulls, by the way. Why? Because 466 is not broken for support. Once that happens, then we know for sure that the bears are taking advantage now. And the bears are smelling blood and they're gaining control of the market. And that could happen as soon as this evening, by the way, if the futures start to trade down aggressively. Speaking of, here's a daily chart for the continuous contract. The SPY, the S&P 500, what's going on here? The equivalent of 466 for the SPY's chart is 4,657. If the futures chart lose that support, then you know that the bears are gaining significant advantage here and they're turning the table against the bulls. A worrying sign for the bulls is the fact that the volume spiked higher on the downside. That's number one. Number two, the momentum indicators are losing steam. Not good for the bulls either. It's too early to call it, but the fact that the SPY and the market in general popped higher, remember that day, the massive day, the pop higher, the gap higher in the morning, the manipulation via algos and options? Well, since then, we haven't had a follow-up, meaning they pumped the market higher, but the retail crowd and the traders during regular hours did not follow up by buying the market higher. What does that mean? If the market maker artificially pumped the market higher via an overnight gap, and there is no follow-up and the market continues to consolidate within range. What is consolidation within range? It's a process of gathering energy. That energy has to be released one way or the other. And if it is not released to the upside in a timely manner, that energy will be released to the downside. And therefore, I say the bears are lurking around. They're smelling blood here, but it's not a full attack yet. The bulls still have some advantage in this market. The technicals are still on their side. The momentum is still on their side. The buy the dip, recency bias still on their side. But boy, the bears are advancing now. What about the Qs? The NASDAQ 30 minutes chart, what's going on here? Unlike the SPY, the Qs lost the support of 397, which the bulls should have held on to and never let go of, because this is an important support. Losing that support favors the bears now. So the bears have a technical advantage in the Qs, not the SPY. If we continue to go down, how far can we go? Number one, you have the support zone. Number two, you have closing the gap. We're going to be eyeing these two destinations here. If that fails, then we got a bigger problem, but we're far away from that scenario, at least for now. What about the daily chart for the continuous contract in the NASDAQ? This doesn't look good, folks. It looks like a head and shoulder formation, a strong one. On top of that, the volume is rising higher on a down day, and the momentum indicators, they did not cross the positive territory to begin with, and now they're losing steam, they're curling down again. Still not a decisive victory for the bears. Not gonna happen until the bulls lose 15,976 once again. If that happens, then the bulls have lost all advantage and the bears will gain significant advantage in this market. Moving on to the Russell 2000, the IWM 30 minutes chart, what's going on here? The weakest link in the market has been the Russell 2000, not the S&P 500 or the NASDAQ. The Russell not doing so hot so today, losing the support of 218 and failing to climb that support by the end of the day. Now we're eyeing 213, and if that fails, boy, we get a massive problem here. Remember the gathering of energy from the consolidation range? Well, the Russell 2000 has been in consolidation range since the beginning of the year. We had a false breakout higher earlier on. What does that mean? In all likelihood, the breakout, the release of the energy will happen to the downside. We have this chart right here that says that the IWM small caps are cheap when you pin them to large caps. And I say yes, I agree, but you gotta be selective here. In 2022, next year, you cannot own ETFs anymore. You gotta be surgical in your picks. You gotta pick winners and avoid the losers. The lazy investment strategy of parasiting over ETFs, that's not gonna work anymore next year. You gotta be careful here. You gotta pick your names tactically. What about the Dixie, the dollar? What's going on here? Still holding on. 96 as support, but we have a bear flag formation. And my hunch is we're going to have sell the news phenomenon. What does that mean? It means Powell will come out hawkish, announcing tapering, ending all purchasing programs by this month, and on top of that, perhaps a framework for raising interest rates. And as a result, the dollar will crash. It is a contrarian call. Everybody assumes that when the Fed tapers, it becomes more hawkish and more tightening happens in the monetary policy, the dollar should move higher. I agree, but the dollar has been moving higher beforehand. So we could see buy the rumor, sell the news phenomenon here. And that will be welcome news to our friend gold. The mature guy in the room who's been waiting for the dollar and the 10-year yield to make their moves once and for all. The two enemies of gold, we have three enemies actually, but one of them is tulips, and who cares about tulips? They're going to crash anyways. But we're looking at the dollar and the 10-year yield. If they go down in reaction of Powell being too hawkish, my bet is we're going to see the rush to the old school safety, meaning gold. I know there are calls out there saying that gold is going to crash, yada, yada, yada. My call is, if the dollar goes down along with the 10-year yield, you bet your ass that gold will move higher. So long as we're trading above 1,763, I'm positive on gold. And here it is, the 10-year yield. What's going on here? A massive flush down, losing 1.5% for sure now. This is a decisive move by the 10-year yield, and the message is the Fed will be too hawkish and the Fed will push the economy into a recession, meaning growth will be taken out of the picture. This is what the chart of the 10-year yield is saying right now. The problem is, when you look at Powell and the dilemmas he's facing right now, he has no choice. I know a lot of commentators in the comment section saying, oh, Powell is never going to raise interest rates because we have the zombie companies and all of that debt, and he can't raise interest rates and crash everything. And my response is, what is the alternative here? What can Powell do? He has no other choice. He placed himself and the Fed in this unfortunate situation between a rock and a hard place because they've been beating the drum on transitory. And we now know that transitory is bullshit. So they have to face the music. And either you're going to continue to be in denial and say, you know what, it's transitory, it's going to fade away, yada, yada, yada. And you're going to risk the phenomenon of stagflation or perhaps hyperinflation in the economy. The other choice is to crash the stock market, to crash the real estate market, and hope that it's going to be a soft landing, meaning a mini crash, a little bit of a recession perhaps, and then we recover right away. These are all false dreams and hopes, of course. Once they tighten aggressively, you bet your ass that the market is going to crash and the economy will dip into a recession because this economy is hooked up on steroids, hooked up on coke. You get the coke out of the picture. The patient, in this case, the economy and the stock market, will suffer a withdrawal. The next support we're eyeing in this chart is 1.375. If we have a flush down, we're going to have a flush down, and this is not going to hold. Anyways, here is the TLT weekly chart. What's going on here? Reclaiming 194 as support once again. This is a fascinating battle that we're watching right here in the bond market. And we talked about it ad nauseum. But the two schools of thoughts are, number one, the Fed tapers. The Fed becomes too hawkish with interest rates, and therefore interest rates go higher. Yields on the 10-year will spike higher. The mechanics will take effect. When the sugar daddy stops buying bonds, well, guess what? Yields move higher. And I happen to be in that school of thought, although it appears that we're losing for now. The other school of thought says, well, if the Fed tapers and becomes too hawkish, by raising interest rates abruptly and higher and faster than expectations, then that will push the economy into a recession. The 10-year yield is the measure of growth, the future growth in the economy. And if Powell and the Fed is going to be too aggressive, then guess what? The prospects of growth will go down the toilet. And therefore, the 10-year yield might go down, but perhaps the 2-year yield, where the Fed has control over, will spike higher. And thus the inversion of the yield curve, which has been always an accurate predictor of an upcoming recession. What about the VIX? What's going on here? 4 hours chart. Still holding at the support of 20. And look at the MACD indicator. It is bottoming and it's about to pop higher again. What does that mean? The VIX is about to pop from a higher low from the support of 20. This is a seismic shift, an important development in the market that we have not seen in a long time, meaning that the bears are gaining advantage for now, if indeed the pop happens, absent of a rescue operation tomorrow. My bet is the VIX will pop higher again, and we will see higher highs, meaning higher than 30 once again. What about a daily chart for Apple, the most important stock to watch right now? We had many false reversal signals. We talked about the shooting stars not once, not twice, but a third time. All of them were false reversals. Didn't happen. Is what happened today the reversal? The answer is, and my bet is, yes. And I put my money where my mouth is, and I bought puts. The 175 puts were closer to the money now, and as the stock continues to slide down, I'm going to open a spread by selling the 165, maybe the 160, depending on how low Apple would go. But the strategy here is, by opening a spread, I will be compensated for my entry cost for the 175. Meaning, let's say Apple flushes down tomorrow. I'm going to open the 165 puts, and I'm going to receive credit for those. Hopefully, the credit that I'm going to receive is going to compensate for the entire cost of buying the 175. Or even better, opening that spread could pay me more than the entry cost of buying the 175. Why? Because the implied volatility is rising to the downside. And using this strategy, you're getting paid to trade. Let's do a hypothetical example of this. Let's say that I bought the 175 puts today for $2 a piece. And let's say that Apple continues to slide down aggressively. And now the 165 puts are worth $2.50 because the stock is trading around 167, 168, right? By opening that spread, you compensated for your entry cost, the $2, from buying the 175. On top of that, you have an extra 50 cents a piece. So you're getting paid to trade. and your maximum profit is $10 a piece. You have the 175. If the stock goes below 165, that's your maximum profit, but your entry cost is pretty much zero. You got paid to trade. If that doesn't make sense, ask questions. I'm going to explain that in a separate video. But why do I say that this is indeed could be the reversal? The answer is, look at the volume. The volume spiked higher on a down day. This did not happen during the 3 shooting stars before. Number 2, the action in the options market was interesting. They were still buying calls in the morning, but they started to abandon these positions and close them right away. And instead, we started to see a lot of buying of puts by the end of the day. What does that mean? It means that the bears are done stalking and they are ready to attack. And my target from this trade is closing the gap, which happens to be around 165. Moving on to Tesla, the souffle. What's going on here? What's happening is bear strike. The bears finally have the last check mark of closing the day below 1,000. This will embolden the bears to pile in and crush Tesla. You notice that the bulls are not buying calls anymore, as if they know that the stock is ready for a pullback, and on top of that, you don't want to fight the big dog. Who's the big dog? The answer is Reverend Elon Musk, who's on the side of bears right now. He still has to dump another $10 billion. So he is on the side of bears right now. And oh, by the way, Reverend Elon Musk is the man of the year or person of the year. And this is interesting, a tweet from Sven Henrik, who says, in 1999, the person of the year was Jeff Bezos, and right there and then that was the top and the market crashed the following year. So are we seeing the same phenomenon? Picking the bubble maker, Reverend Elon Musk, as the person of the year means that Tesla is going to crash in the following year, and if Tesla crashes, then the entire market will crash down with it. But for now, we're eyeing 900 as support. If that doesn't work out, then the chart will be eyeing the trend line. What number, you might ask, on the trend line? That depends on how soon and how fast the chart will revisit the trend line. It could coincide with 900 depending on how long the chart will consolidate before taking that leg down. Moving on to tulips. What's going on here? The bear flag is working. Don't touch it here. Wait till 42,000. Because even the pump over the weekend from the Indian Prime Minister Modi, that did not work either. Somebody hacked his account, of course, and started pumping tulips. And if anything, this is an illustration that the market has a lot of scammers, a lot of filth that has to be washed out first before tulips and BTC become investable once again. Lastly, what about AMC? What a tragedy. Losing the support of 26, the most important support. What does that mean? Game over. You have a bear flag that could flush down yet again. I'll give you till the end of the week. For the apes, that is. I'll give you till the end of the week for the rescue operation to happen and recapture 26 as support once again. If it doesn't happen, then game over for sure. If AMC closes below 26 for the week, it's over. We're going to stop covering this chart. I'm not going to go with the I told you so right now because you're already wounded. I don't want to pile in right now. But at some point, you and I are going to have a heart-to-heart talk. Because the last thing I want to see is retail investors, mom and pop, who work so hard for their money, to be taken advantage of by Wall Streeters, hedge funds, and pumpers who have no shame at all, no conscience whatsoever. And they lure retail investors in these pumps and dumps schemes. They get to cash out and they leave the retail crowd holding the bag alone. And lastly, what about the chart of the XLP consumer staples? As you can see, this chart has been outperforming the market for now. Why? Because consumer staples are the true safety in this market. High cash flow, pricing power in this inflation, and nice dividends. What's not to like? The problem is it looks toppy for now, but the evidence is clear. When you pin the XLP consumer staples in red with the XLK technology ETF in yellow and the SMH, the chips ETF in blue, the SMH and XLK are curling down, losing momentum. On the other hand, the XLP is curling higher, gaining that momentum, and you're seeing the rotation right before your eyes. Away from the exposure in tech and growth to where? The safety of consumer staples. The problem is, even the XLP's chart looks a little toppy. So you have to be picky here. We know that consumer staples are outperforming, but you gotta pick your names. Don't buy the ETFs here. You gotta pick individual stocks from the ETF, because if you look at Costco, for example, a huge component of the XLP, it's an excellent stock. The earnings were pristine. They're making a ton of money. But the problem is the stock is too toppy. You're going to have profit taking in Costco rotating to other stocks, and this will dent the XLP down. You look at another component of the XLP, Clorox, for example. Now, this chart doesn't look toppy. If anything, it looks like an opportunity to buy, because we have a descending sloping line of resistance. This is a weekly chart, by the way. The chart broke above that line and reconfirmed it as support. What does that mean? I bought call options with the intention of owning the stock if it happens next year. You see the momentum indicators, the RSI, the MACD, all moving higher, gaining steam. The bottom line is, you gotta be picky. You gotta be surgical and tactical in your picks. Don't be lazy and buy ETFs. There are gonna be winners and losers. Buy the winners, avoid the losers. Easier said than done, but you gotta use the technicals as a guide here. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We don't have a lot. We have the Small Business Index, and most importantly, the PPI, the Producer Price Index, which to me is more relevant and important than the CPI, aka the CPI. And the reason is, there is less incentives to manipulate this number. That's number one. Number two, it serves as a leading indicator for the upcoming CPI, and therefore we're going to watch the PPI closely. And the expectations are the number will come out hot, hot, hot. On top of that, we're eyeing the cabal of central banks. A lot of them are meeting this week. Tomorrow, Tuesday, we have the countries in yellow. I can name Chile. There was another country in Africa that I cannot name. And then we have, what is that, Pakistan? But of course, most importantly, on Wednesday, we're going to have the Federal Reserve. Papa Jerome Powell will talk and everybody will listen. Thursday, we're going to have the Bank of England, the ECB, the Mexican Central Bank, and on Friday, most importantly, the BOJ, the Bank of Japan, and the Russian Central Bank. They will all follow the guideline from the Federal Reserve, and therefore Wednesday will be the most important day in this week. Until then, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow.